evening, everyone. Many thanks for the kind introduction, Aditya. So we have a fabulous topic for discussion today. That's the private equity and venture capital exits and the key trends rising out of it. So whilst I would like to believe that the interests of LPs and GPs are mostly aligned, but when it comes to exits, by all means, they are truly aligned. As GPs are looking to make carry, whilst LPs are looking for handsome returns. So could not have asked for a better topic to moderate and could not have asked for a better set of diverse speakers here, which we have got. So though Aditya has made the introductions, but I have got the PE industry veteran and champion Devanjeet with us. We have Neha from IFC and we have the best possible LP voice here as well, right, in form of Neha, and would expect her to not bully the GPs around because everybody is desirous of a check from IFC. So we of course have Umang here from IFL, and I've stopped keeping a count of the number of heads among wares with his funds in IFL. It's a pre-IPO fund, PEVC funds, the debt funds, fund of funds he manages. So at times I see him as a LP, sometimes I see him as a GP. So we can expect some real interesting inputs from Umang as well. And then we have Norbert with us, who leads the secondaries and fund restructuring investment strategies. And as a gentleman, even traditional private equity and venture capital players would look at him for exit. So it would be very exciting to listen to him as well. So with this quick introduction, maybe I will immediately start with Devanjeet. And my very first question for you, Devanjeet, would be that SEBI, as you're aware, had earlier permitted even the loss-making companies to come out with IPOs, which meant like companies not having the typical 3 years of average operating profits over last 3 years. Even they were not having that, the likes of Zomato's and Paytms you saw made their public market debut. Now, however, SEBI, if you would see in December 28 board meeting, they came out with certain norms. Chairman also made some observations that they are observing more and more of the offer for sale portions in this IPOs. And SEBI has come out with certain limits of how much the private equity or venture capital folks actually can offload in IPO, how much can be the OFS portion versus the fresh portion. And of late, we all have been observing some sort of like a performance with all these unicorns, particularly the cash burning companies, and there has been some stock market debacle. So do you see anything changing from the perspective of the IPOs of many of these upcoming companies, particularly the ones which are burning cash, and does it in turn impact the exits in your view? Please let us know.
Hi, Tejesh, and it's a pleasure to be here today. I think there are 3 questions in your 3 parts to your question, Tejesh. Very, it's a nuanced question. So the first part, is relating to IPOs of loss-making companies. I think this is an area which is as part of the overall maturing of the Indian capital markets. I think it's a logical progression. There are IPOs of loss-making companies in multiple jurisdictions, and prior to this being permitted, one of the concerns of the regulator obviously was that they did not want loss-making companies to list and have investors who do not understand these companies or don't have the wherewithal to analyze these companies participate in such companies. So I think as a part of the overall evolution and maturity of the Indian capital markets, this is a very logical step and logical direction for the Indian capital markets to go to as the investor community participating in the capital markets matures. The second part to your question is relating to OFS and selling by private equity, selling by insiders. Again, this is, I would say, a part of the overall evolution of capital markets. In most jurisdictions, any sort of IPO or any sort of sale where insiders are selling, is a sort of a red flag, if you call it, or is a sort of a flag for investors. And most buyers, are aware when private equity invests in markets or in companies, there are limited life funds, and being the closed-ended nature of funds, private equity investors do need to sell. So while there is insider selling of one nature, which is where an insider may have information of a certain type, which may have a better understanding of the company. In the case of private equity, I think it's more driven by also the nature of the industry, where being a closed-ended fund, The private equity industry does need to return capital to its LPs, and therefore, a lot of the selling is motivated by, what the life of the fund is and having to return money to LPs. In fact, in more developed jurisdictions like the US or Europe, 100% owned companies by private equity, have 100% of the offering as secondary offerings to provide exits to private equity investors. And again, I think this will be one more step in the evolution of the Indian capital markets when it gets to there. It's still not there yet. In today's market, you can probably sell maybe 30, 35, 40% of a company, in an IPO situation, and not more than that. But I think the regulator is again just maybe a cause for pause in terms of making buyers beware, making just calibrating the overall evolution of the market in this aspect. But OFSs and selling by private equity is there's nothing sort of malignant here. It's something that is just because of the nature of private equity capital is just par for the course. And your last question was, I guess, related to IPOs of loss-making companies and, recent loss of valuations or, debacles of some companies or the loss of, some valuations in the NASDAQ. So, this is not very different from, any sort of capital market cycle. There are flavors in the market. There are, market cycles. There are some sectors that come into flavor. There are some sectors that go out of flavor. So I don't see that particularly as being a trend or anything for for us to worry about. There will be times when people want to look at more defensive sectors or value-based sectors. There'll be times when investors want to look at more attractive or growth-based sectors and willing to accept losses for some period of time. In higher interest rates environment, the valuations of those companies, and which is what we're seeing today, will be impacted. So I don't see that as particularly being, anything more than just, market cycles, markets, recycling capital to newer and, what they think are better opportunities.
So you would believe that it may be more a knee-jerk reaction actually from the regulators that basis a very short-term scenario, they have tried to curtail the OFS portion, which ideally I think some more time should have been waited, right? That
yes, I would agree with that. I think that in the overall evolution of markets, whether it's a primary capital or it's secondary capital, I think investors understand who the nature of the seller is. If there is a promoter as a seller or a who is selling for a particular reason, that is a different signal to the market. A private equity investor selling because his life of fund is coming to an end or because he needs to return capital to their LPs. Again, the market understands why they are selling. So I don't see anything malignant there at all. And I really frankly don't see why that aspect of it needs to be regulated.
All valid points, Navinji. Thank you so much. Umang, coming to you, since other than the IPO route we were talking about, what all avenues are you witnessing as far as exits are concerned? Because at IIFL, as I said, you are managing multiple strategy funds across like asset classes. So what's your view on that?
So thanks, Tejas. First of all, thanks to also Equalify to call me for this discussion. So I'll just take a step back, just talk about the strategies which can be potentially there in category 2 AIF. So starting from the early stage, then you get to mid stage, and then you get to now what we call the late stage or pre-IPO funds. Now, besides what you said is the IPO exit, which is the most ideal situation for everybody. But it's not possible for an early stage investor to kind of wait till the IPO comes in, or a mid stage person to come till the IPO, because the fund tenor might get over. But what's happening is that both domestic capital as well as the capital being raised outside is happening more at a late stage, where the fund comes in 2 to 3 years before the IPO. So we are probably expecting $1 trillion or $2 trillion worth of value creation in these startups, out of which say maybe $400-500 billion might be listed in 2025. Now, what is the kind of funds which we have raised? Maybe 2 or 3 AIFs totaling up to $1 billion. That's it. So it's a huge market which still needs to be captured, and that is getting captured. So that could exit for early stage to mid stage companies. That is one point. The other is, at least from our experience, from the past experience, what we've seen besides IPO exits, a large part of exit has happened to strategic investors. So strategic investors are coming in, and you've seen, for example, Geo coming in and picking up a lot of companies in between. So there are, certain strategic which keep coming on the way, and you have to take a tough decision whether, and the promoter, obviously the founder, has to take that tough decision to completely get out and merge with somebody else. So that's the second large strategy which we have seen for exits. I think as time progresses, these crossover and late stage funds will become large enough a category for you to give exits to mid and early stage funds.
It's really critical. I think the strategics, that aspect is going to be very critical, and more such kind of deals are happening. So thanks, Umang, for those insights. Coming to you, Norbert, at TR Capital, you primarily run secondaries and fund restructuring investment strategies, and these funds really hold a lot of significance as they can provide exits not only to other private equity and venture capital players in their portfolio companies, but they can also buy out all the remaining assets of a fund which is ending its tenure, all right? So it's pretty critical from a exit perspective. So how critical is this strategy in your view, how it's practically turning out to be, and any learnings for India from your global experiences?
Sure, Tejesh. And also, first of all, thank you for having me on this panel. So the way I look at it, if you look at, if you take a step back and see how India has evolved, the investment ecosystem, there's been a large emphasis on just making sure investors feel comfortable putting in money in Indian companies, in Indian funds. Focus has been on the investment side, just making that path very clear. And on the exit side, and it's a matter of time and evolution, I think there are a lot of rough edges on the exit side, and I think over a period of time that will also get smoothened out. And when I say rough edges, there could be regulatory nature, just making a very simple tax treatment for exits, or making very consistent over a period of time how P exits or public listed exits are treated, just not having complicated grandfathering situations, stuff like that, right? And also what I would call market maturity issues, in the sense that, is the IPO market deep enough for the kind of exits that we need vis-a-vis the investments that have gotten? Again, this is a function of time. And again, on the market side, I think we see these large exits happening, and those are beautiful, but there's a lot of sort of mid-market stuff that needs to happen in an ecosystem on a very regular basis. Mid-market buyouts, strategic acquisitions, secondaries, that keep the plumbing very smooth across check sizes. So when you think of secondaries, the way I think about it is, it's part of the plumbing that keeps capital flowing at a regular pace from entry to exit. And globally, secondaries have formed a very important part of that plumbing, so to speak. In India, I would say it's a relatively new asset class, and we certainly have, I would say, quite proudly played a part in bringing it a little more recognition and making it a little more well known. I myself have spoken to a lot of fund managers and educated them that this is certainly something that you should think about, and this is becoming more important now, because the lifetime of private investments is just getting longer. Companies are staying private for much longer, and very often that means it's exceeding the lifespan of the fund. So what do you do at the end of it? And we certainly do play a role there. So I think definitely it's becoming more and more important in the larger scheme of things for generating exits for GPs. And if you ask me what learnings, we've been operating across Asia, so it's not rocket science. I think some of the learnings we've brought into our India investments, and we've been doing this for over 10 years in India now, is just to be as close to the asset and the management as possible, even when we do a portfolio transaction, right? Doing it passively and having someone else manage it doesn't work. It's just important for us to be very close to the management and the promoters. Secondly, maybe I would say is an approach which has not worked for us is, being very discount focused when we are doing a transaction. We are certainly of the philosophy that we look for high quality assets at a fair price. That's done well for us. And probably a third lesson for us is just be more aware of cycles. And we do look for value in what might be considered currently neglected sectors that are just silently and quietly executing and doing fundamentally really well. So I think that's sort of broad way of how we look at things.
Sure, no, but thanks. So I think one very interesting observation that these mid-market buyouts and secondaries are a part of a plumbing sort of a mechanism which keeps the capital flow intact. So I think that's great. So thanks for that. Neha, coming to you. See, as you're aware, SEBI permits only 2 years of extensions for the close-ended funds in India. So when you're invested in category 1 and 2, that's the maximum time period which the AIF regulations permit. Now, IFC has been a large investor in several Indian funds. So from an LP standpoint, what's your take on the fund extension sought by GPs? Because there are several funds which are finding it difficult or finding the current extensions insufficient. So should regulator be more flexible and leave it to more the discretion between the LPs and GPs to contractually decide in genuine situations? So what's your take on that from a LP perspective?
And thank you so much. It's a pleasure to be here. So I think let's look at the context of this entire problem that has emerged, right? And if you look at it globally as well, the average life of a fund has been increasing over time. If you look at it in 2008, I think there was a study done which said average life of fund is 11 and a half years. In 2014, in the next 6 years, it increased to about 13 and a half years. And recently, a couple of years ago, there was another study done which said the average life is actually now close to 15 and a half, 16 years, which means that the average fund life of 10 years with 1 or 2 additional extension years, which is not a given, it is given so that the LPs give you the flexibility to the GPs to exit. But it seems like this is being taken for granted, and it's not just in any one country, but this is the global average. So globally, I think the regulator coming down on this hard is a good thing in a way, because it helps give a strong message to the fund managers, the entire fund management community, and this is not just here, but everywhere. It's not a given. This is something that has to be used sparingly. This is an option. This is an optionality. This is not that the fund life is 12 years. The fund life is still 10 years. So please plan your exits accordingly. Having said that, I think as an and having been a GP on the other side, I know that there are situations where you can't control this. And for example, COVID is another way where we see that for 2 years, the fund managers have not been able to exit, or the exits have gone down considerably. Well, there should be flexibility. There cannot be, one way. It's never a binary game. It's never 0 or 1. So there should be a middle ground. And I think it is for the GPs and LPs to decide. However, in funds where there is a lot of broad-based ownership, there are very few institutional investors, I think there could be a little bit of tightening, and I would support that as an LP, because I feel that this provision is being misused. However, we should not be taking it, nothing is black and white. And therefore, if SEBI says all funds have to close in X years, I don't think that's the way to go as well.
Yeah, sure, interesting views. And maybe I may have a possible contrary view from Devanjit here, because we had the LP perspective. Now from a GP perspective also. Can you see of practical scenarios wherein GPs may genuinely need an extension, and say in order to expect better exit, there is an IPO which is upcoming, but your hard-coded close-ended term is getting over. And what's the expectation from regulators? Because Indian regulations are watertight here and currently leave no room for extension beyond 2 years, except for recently introduced high-value accredited fund. But the requirements there are like pretty stringent. So what's your take on that?
I think, there's a very basic disconnect here that I have with regulating something like this. And the basic disconnect is that this is not a product, or this is not a asset class which is for retail investors. In large part, the participation here is institutional investors, large family offices, and sovereign wealth funds, insurance companies. That's the nature of participation in this asset class the world over, and including in India as well. There's a limit of 1 crore for any investor to participate in this asset class. And now we have the concept of accredited investor as well, which is, I think, a very, very positive development. So I think the ability or the need for SEBI to protect what are, I think, big boys, in that sense is limited. This is a private placement and private raising of capital, and the contract is between the LP and the GP. So the ability or the need for a regulator to interfere in what a contract in that contract, to my mind, is should be limited to the relationship between the LP and the GP. The LPs don't like what the GP is doing. They vote with their checkbooks and don't invest in that GP the next time around. It's as simple as that. Like I said, the need for institutional capital or for what are big boys to be protected in a scenario like this is limited. The second aspect is, again, comes to the level, comes to the topic of maturity. And this is what Norbert alluded to. There is a very limited ecosystem in the Indian market for secondaries, funds coming to an end. The ability for that fund to close, distribute capital, through the secondary mechanism is in some sense limited. So I think, mandating hard lines for, funds to liquidate within an X time period or Y time period, which can lead to potentially, distress kind of liquidations, is probably unwarranted.
No, fair point, Devanjit. So point well taken. Coming to you, Umang, how you are viewing a lot of the recent regulatory changes from an exit standpoint. So now, for instance, the earlier 12-month time period to avoid a post lock-in has now been reduced to 6 months. So if any PE/VC under category 1 or 2 is holding the security for more than 6 months, the post-IPO lock-in exemption is available to them. Now, what SEBI has also done is to permit fund of funds to invest into a mix of securities in the units of other funds as well as in the shares of the portfolio entities. Earlier, you had to pick that if you were acting as a fund of fund, all you could have invested in the units of other funds, but not in the portfolio entities at the same time. So a lot of these liberalizations have happened. So in your personal view, can these serve as one more sort of an exit avenue for other non-fund of funds in the market?
Yeah. So fund of fund becoming an exit opportunity, I'm not too sure whether that is that is too early to comment. But I think what will happen, as so slightly digressing to the fund of fund question, because you asked me second, is that it, of course, so just to give you a little bit of history, we first came out with a fund of fund in 2015, which had both options to, because there was no clear rule at that time. Then the second fund of fund which we launched was only funds, and now, of course, the thing has got reopened. But I'm not too sure whether a fund of fund, when it invests, will act as an exit kind of a window for some other fund, because what mostly a fund of fund will do is to kind of co-invest along with the funds which he or she is investing in. So most likely it's going to be one or two key opportunities which he gets from the fellow funds which he has invested in. So I'm not too sure about that part, whether fund of funds will become an exit route for other non-fund of fund funds. That is the second question. Now, first you said about 6 months. I think that's quite a positive step. Anyway, AIFs had that advantage of 1 year, which so for instance, to give a live example, a lot of our funds hold National Stock Exchange, and we've been holding this for 2 to 3 years. So typically, we can sell it on day one if we want to. I'm not suggesting that we would want to sell on first day, but I'm just saying that if we want to sell it, we can sell it on day one. Whereas any other non-AIF entity will have to still hold it for 6 months, earlier 12 months and now 6 months from the day of the listing. So that, of course, is an advantage. It was 12 months and now it's 6 months. But still that advantage remains, because the kind of volumes which funds play with, and also going back to your old question about whether insiders are selling, etc. So I just want to add a point there, because just imagine a fund who has 25% in a company. If he doesn't give 5% in the IPO, how do you expect him to, get out of 25% of that company through the public market? So that also, I think, needs to be fathomed. So let's assume he sells 5% in the IPO. The IPO lists at premium, hopefully, and he still has that possibility. He can offload, maybe 2, 3, 4% on that day, because the liquidity on the first day of listing is always the highest and it wanes off. So these are things which I think are quite positive for AIFs in general. So, and it gives a large AI for a large stakeholder in a company the possibility of exiting without friction.
Great point, Sumang. Thanks so much for that. Coming back to you, Neha, like, what has been your experience in the last few years in India as far as the private equity and venture capital exits are concerned, say purely from an investor lens? So our money is being returned on time. The returns, have they been lucrative enough compared to what you are seeing in the global markets? Because IFC is a large global investor. And if any particular strategies have been more lucrative than the others. So what's your take on that?
I think your first part of the question was whether we are seeing more exits, we are seeing money being returned. For sure, yes. I think for recent vintages, if I compare with, let's say, 7 or 8 years ago, definitely the average holding periods have come down. And this does not mean that returns have come down. Returns have actually improved, both in terms of IRRs as well as MOICs. I think it's also a function of the market, right? Because the market is booming, and this is the time where a lot of funds are finding the right exits and also taking the right steps. I think the second side of that is also that, as sort of Devanjit mentioned, that fund managers are maturing, and they understand that if we don't deploy and exit in time, then we will potentially be in a position where we would have deployed the whole fund, not exited anything, and therefore we will not get LP interest for our next fund. And therefore, when they are investing, they're very conscious that they need to shorten the average holding period while not hurting returns as much as they can. I mean, there will be some compromise, of course, where you can compound an asset over 10 years versus if you compound it for 5 years, you will definitely have a lower MOIC. But it doesn't mean that returns are bad. They're relatively lower, but I think for a PE fund, they're earning good returns. So yeah. And I think globally, if I compare this globally, I think India has been in a boom for sure. And when I compare performance of Indian funds, whether it's on the early stage side or on the PE side, I think Indian funds are definitely giving some good returns. Even if I look at other markets like East Asia, I think East Asia has performed really well over the last few years as well. There's been a lot of liquidity, there's been a lot of interest. Again, Africa also, we are seeing certain sort of fund managers, certain investments do very well. But for sure, India is amongst the top few sort of countries, a few regions to make money.
So great, some real encouraging words, Neha, because one thing which stands out is that the holding periods have reduced, but returns have not necessarily reduced. So I think some good insights, some I would say optimistic scenario for the private equity and venture capital managers. So India is here to stay and really do well. Thanks so much for that. Norbert,
if you allow me, I'll just add one point
please,
to what Neha said. So as you initially said, I also wear the LP hat, and we look at client portfolios, and if one has allocated, right, even say 5% or 6% to the VC class, we've seen funds returning 9 times or 10 times your investment, right? So that's never happened. We've not seen that before, right? So typically, if you have a 100 rupee portfolio and 5 rupees into the VC class, you've got 45, 50 coming back. I mean, of course, there's carry which gets deducted, but that's the kind of return which people have seen. And just rewind yourself 3, 4 years, 5 years back, people were not touching this asset class at all. So it's a completely different, just adding to what Neha mentioned. So the complexion of your wealth, your portfolio completely changes.
Nomang, and I think alternatives really need to go mainstream, right? Because today, for somebody who is not even say an ultra HNIM, but where they are investing money in directly in markets or in mutual fund units, I think alternatives really need to be seeing more participation. And I think one point what one of the panelists made in the some time back is on the accredited investor concept, right? So that 1 crore is not going to be a ticket size issue anymore. Anybody who goes seeks an accreditation, actually you are really going to see not only new domestic institutional class opening up, but also a lot of say retail plus participation also getting in, wherein you can see 25 to 50 lakh check sizes getting very critical move. very timely move.
So I'm not sure whether retail comes in there. So just let's take a hypothetical example of somebody who has $5 million, so say 35, 40 crores of net worth. So, and he decides that 25%, 20% should be in the alternate asset classes. So that's 7 crores. Now, beyond 7 funds, he can't do anything, right? So he now can do, say, 15 funds of 50 lakhs each, and which is a good diversification across asset classes. And mind you, this is a 35, 40 crore net worth person who's not a small, that's not a small net worth by any stretch of imagination. So that's good. But the other aspect is what you'll have to see is, will funds want to reduce that 1 crore? That only time will say, because there's a limit of this 1,000 investors, right? So if you take start taking 30, 40 lakh checks and suddenly you get 1,000 investors, you might not reach the size you want to. So that will be another tricky one, which we will have to see how managers kind of want this to be lowered.
Sure, the 50 lakh, 75 lakh sort of check sizes among which currently are unaddressed, and purely because of the regulatory restriction, if somebody is not taking exposure here. And also right along with the point that the returns have been handsome, right? You are saying the 9x returns and 10 times returns which have been generated, actually monies have been returned. I think taking all these together, you may definitely add more money, but it's a valid point. Maybe regulators have to think more if they are getting into the AI as a concept. That 1,000.
I think that 1,000 investor limit has to kind of change.
Has to go up. I think that's a very fair point.
So, right, and if you have a fund, 2,000 investors or 1,500 investors, it's going to be crazy for the fund manager to manage it. So I don't know whether, as a fund manager, would someone want to have a fund with so many investors? I mean, mutual funds, of course, but I think PE is a little bit of a different animal. You need confidentiality. You don't want your information to be out there in the open. And then how do you maintain transparency, but also maintain sort of confidentiality at the same time? But I just want to more point to what I think absolutely correct that VCs really boom. But we have seen a lot of good returns from even our mid-market fund managers. So fund managers who are investing in growth equity, we have seen some tremendous returns, and this is across different sizes. We've seen this from managers who are, more than $500 fund sizes, $1 million fund sizes, even from smaller funds, which were between the 200 to 300, 200 to 400 sort of $1 million fund size. So I think returns overall have boomed, and we've seen similar returns like 20x and 7x and 8x, even from growth equity managers. So I think money's been made all across. The question is, are you selecting the right managers? And therefore, selection is becoming very critical.
I think the AI concept, AI is also going to get very popular with category 3 managers, because you see a lot of senior folks from the mutual fund industry who have started their public market funds, long short funds, and who have run the PMSs in the past. I think for them, handling the number of investors is not an issue, because they've already seen the mutual funds, the kind of the retail money and number of investors which are there. So there it's going to be really, really going to gain prominence. But you are right, maybe category 1 and 2, how does it pan out purely from the number of investors? Because sophisticated PE and VC managers would like to have as less number of investors as possible in their funds. So definitely will have to be seen. Fair point. Norbert, coming back to you, in the recent budget, you would have seen that government has proposed several sunshine sectors like fund of fund focused on agri-tech and EVs, and a lot of climate focus has been there. SIDBI fund of fund has been there, NIF has been there, SRI fund has been there for a while. Now, but isn't there a need for the government to think from a long-term perspective and also announce the secondaries funds, the distressed or the special situations funds, the buyout funds, etc., to be seeded by the government to achieve that multiplier effect, and then managed by the professional fund managers? So what role you believe the government in India can meaningfully play here to showcase exits also to the global investors, because it's equally critical to attract that kind of a global capital in India from a long-term perspective? What's your take on that?
Sure. So I agree. I think a lot needs to be done in building out the exit infrastructure in India. But I think what the government has a set of priorities at any point in time, and it has been to attract investment, and understandably so. And within investments also, a lot of the schemes, the way they're run, they will be targeting areas which align with national objectives and national agenda. So EVs, for example, they will like to attract private capital. And the way it works is they'll put down 1 rupee, and the fund only can start operating after it attracts a certain threshold of external capital. So the objective is to amplify the government budget in a sense. So now, what can it do to build out the exit infrastructure? Creating a secondaries fund, etc., I think is certainly one way to go. But I think there are far more lower hanging fruit which the government can attack even before that. Like I mentioned, just simplifying tax codes is one thing, simplifying SEBI ICDR norms for companies listing, and some of these points have been raised already on OFS, etc. Here, I actually want to make a related point. I think um, there has been a lot of focus on retail investor protection by SEBI, and you've seen it over cycles. Even in 2008 to 2011, when there was the last IPO rush, after that, some of the IPOs started bombing a bit, and there was this hue and cry about investor protection and stuff like that. And I remember seeing the Just Dial DRHP, which contained a safety net clause, which says that if the price goes down below a certain threshold, then the promoter has to buy back at the original IPO price. So stuff like that, so there's a fine line between protecting a retail investor and just outright, I think regulatory overreach. So I think some of that needs to be very clearly, that path needs to be walked very carefully, because whichever way you look at it, overprotecting a retail investor becomes sort of, in some ways, exit barriers for funds, right? Because it just becomes harder to achieve those thresholds. Also, I mean, the flip side of this is, I mean, look at the IPOs, the prices at which a lot of investors have exited at, and then it's gone 2x, 3x from there. Investors have also left money on the table in these IPOs. So it's hard to look at it only in one direction and say prices have come off, so therefore we need to put restrictions on OFS and stuff like that. So I completely agree with Devinjit on all that. So anyway, larger point being, of course, lots to be done on building secondary space, etc. But even the private equity space got built on its own. I think you create a framework of fair rules and tax code, and the money does come. The government, all these schemes came later, by the way. The private industry emerged on its own, and so will the secondary space.
Brave points, Norbert. I think the regulator is listening. I think the overprotection of retail has always been an issue. So, but SEBI being the retail regulator, that way they will have a particular mindset. But I hope there is a balancing act. So that's the need of the.
But I think from the overprotection of the retail investor, I think protection of the retail investor is SEBI's role. I really want them to stay away from protecting institutional investors. That is really not needed.
Valid points, Devinjit. So, all right, then before I conclude the session, I would like to do a quick 5-minute sort of a rapid fire round with my esteemed panelists. So let me start with the lady first. Neha, my quick 4 questions for you. One, what's your 2 top expectations from the GPs as a LP hat, what you're wearing, please?
Well, I think, okay, the first one is very clear. Make money for us, right? Make money for us, please. We don't need anything else. Please make money. I think the second expectation would be communicate with us. Let us know if something is going wrong or if something is going right. Either ways, let us know so that we're always in the know and we're not reading about it in the public from hearing from it from someone else or public. That's it.
Great points. Neha, sector you would not invest in whilst you are seeing everybody is rushing for it. What's your view?
I think right now I would, and this is personal opinion, I would stay away from the tech sector. Like I would be careful. I wouldn't say I would stay away. I would be careful, and I would really scrutinize it before cutting a check for this sector, because there's a lot of froth as well. Of course, there's a lot of good assets, but there's a lot of froth as well. So I'd be more careful.
Interesting. One area, so now this is an interesting one. Yeah? One area where you tend to get unreasonable as a LP. Different people like that. And Norbert and so will Umang.
I think, and this I speak for as an LP, I think corporate governance or you would say anything where there's a reputation risk. I think we are almost sort of to the extent of being unreasonable, because we don't want anything which can impact our reputation. We would not like to be associated with it.
A fair point. No, I think that's required. So last point for you, you prefer physical meetings or travels or the Zooms or team meets, virtual meets? That has been the story for past 2 years. So what would you prefer more going forward?
I think I'm looking forward to meeting more in person. I think we still haven't, as a rule for our organization, we've not started physical meetings, but I do prefer that.
Great. Thank you so much. Devanjit, coming to you quickly. Top 2 sectors you would love the most as a fund manager today?
Financial services and consumer retail.
Great. Top 2 aspects where you genuinely believe that LPs should be more reasonable. It's a flip of the question.
So I think, when it comes to, younger managers, and I think it's a level of maturity, some LPs, understand that managers need to build infrastructure and not so, aggressive on negotiating fees. Others don't seem to get it that, we do need to, build teams, build infrastructure to be able to generate the kind of returns that, we look to make. So especially for younger managers, I think LPs should not be as aggressive on negotiating fees. The second aspect, which again, I think is often managers need to pivot. And investment strategies need to pivot and to have flexibility around that. For example, post-COVID, a lot of investment strategies needed to change. Disruption became so much more real and accelerated that managers did need to pivot their investment strategies to the new environment. And I think for LPs to understand and appreciate that, I think is important.
Great points. What's your view on the Indian market as far as FY 22-23 is concerned? 3 choices. You're cautious, you're cautiously optimistic, you're bullish.
So I'm optimistic, but I think it's a very nuanced response, because I think the performance this year by sector will be very, very differentiated from what it's been in the last year.
Makes sense. One thing which private equity world is not aware about, Devanjit.
No. That after investing $1 billion and making about $3 billion of gain before every investment, I still feel the same nervousness I did before taking an exam in school, or similar to a batsman going out to play his first test innings.
Great, very candid one. Thanks, Devanjit. Umang, to you, your favorite strategy? You run so many. Your early stage, you have fund of fund, you have pre-IPO and whatnot. So what's your pick? The best one for you?
So I personally like the late stage strategy a lot, because you get both, P, or if it's a loss making, a price to sales re-rating, plus you get the growth. So it's both the variables are working for you. So that's my favorite.
Great. Toughest investor class to deal with, what you have experienced?
No, so I've been lucky there. So we only cater to accredited investors and institutions to some extent. So I'm not too sure whether I would have been able to handle retail.
Okay. Okay, great. So I think it's a right question. The best web series or a movie in your view on fund managers? Last 2 years, I'm sure you would have got some time.
Yeah. So without any doubt, it's Billions. It comes on Hotstar for somebody who's not watched it. You have to see that.
Wonderful. Good insight. I will do that. Now, you prefer physical meetings, travels? Again, the same question, over your Zoom or Teams?
There is no doubt. I think I'm disagreeing with most of you, but no doubts. I love my Zoom meetings and I love my Microsoft Team meetings. It's simple, Tejas. Just I shudder to the fact that I used to get up 5:30, even to go to a place closer like Bangalore and be there for the first meeting at 11 o'clock. Can't imagine 6 hours to start your meeting. Zoom is no doubt my option.
Totally agree. Norbert, your turn. Which new technology you believe is disruptive or will transform the future?
So I think there are 2 things are going to transform life in our own lifetimes. One is augmented reality, and the second one is autonomous driving. I'm big believers in both.
Great. Your 2 favorite sectors, maybe related ones?
Consumer tech, fintech.
Great. The best movie, web series you would have liked as far as the Indian fund managers or the PVC world is concerned. Let me put it.
So web series, I'm a big fan of Silicon Valley. I mean, it's not Indian related, of course, but it's super funny and gives a good capsule of the madness that happens in tech investing. And a movie that I really like is a movie called Upstarts. It's actually directed by a very good friend of mine. It's on Netflix, which talks about an Indian startup journey, fundraising, how it impacts their equations with each other. It's very nicely made.
Okay, great. I thought somebody would say The Big Short, actually, the kind of LPGP relationship they are shown there, that, okay, when you're not making returns, how LPs can come to your office and use all the terms. And later on, when you give like phenomenal returns, actually, and then what's the observation?
I
That's
think people are
also...
playing it a bit safe.
What's your view on the Indian market? The last question from me for the FY 22-23, cautious, cautiously optimistic, bullish.
I'd say bullish on business and cautiously optimistic on valuations.
Good one. Great. So all of you were great, and I'm not picking up a winner here. It wasn't a coffee with Karan, so not distributing any hampers. But so thank you so much, Devanjeet, Neha, Umang, and Norbert, for keeping it so interesting. So I'm sure attendees got some real good, interesting insights. We have probably also finished within our allocated time. So I'm assuming Aditya and organizers are happy too. So thanks, and be safe and have happy times ahead. Over to you, Aditya and team. Thank you so much.